Imagine placing a trade with complete confidence, only to watch helplessly as your emotions destroy everything you planned. This scenario plays out thousands of times every day in trading markets around the world. The devastating truth is that most traders fail, not because they lack intelligence or access to information, but because they never master the psychological battlefield that exists between their ears. Picture Sarah, a software engineer who spent months learning technical analysis. She could identify perfect chart patterns and had memorized every indicator formula. Yet within 3 months, she had lost 60% of her trading account. Her problem was not knowledge, but the panic that gripped her whenever a trade moved against her position. Mark Douglas, in his groundbreaking work, The Disciplined Trader, reveals the hidden psychological traps that cause even the smartest people to lose money consistently. Today, we will explore the exact mindset mistakes that separate successful traders from those who struggle endlessly, despite having access to the same charts, indicators, and market data. The journey begins with understanding that your greatest enemy in trading is not the market itself, but rather the psychological patterns that drive your decision-making process. This becomes crystal clear when you realize that two traders can look at identical charts and make completely opposite decisions based purely on their emotional state. Most traders enter the financial markets with a dangerous misconception. They believe success comes from finding the perfect strategy, discovering some secret indicator, or mastering the most reliable chart patterns. Mark Douglas makes one fundamental truth crystal clear. The real challenge has nothing to do with strategy and everything to do with what happens inside your mind. Consider the story of Mike, a successful doctor who approached trading like a medical diagnosis. He believed that if he could just analyze enough data, he could predict market movements with scientific precision. He spent thousands of dollars on courses and software, yet continued losing money because he never addressed the fear that made him exit winning trades too early and hold losing trades too long. When you place any trade, the market operates with complete indifference to your personal situation. It does not care who you are, what you think, or how desperately you want to win. The market functions as a completely neutral environment, responding only to the collective forces of supply and demand. Here lies the fundamental problem that destroys most trading careers. Traders are never neutral in their approach. They attach intense emotions to every single price movement that occurs. When the market moves in their favor, they experience excitement and euphoria. When price action moves against their position, they feel overwhelming fear, anxiety, and frustration. Take the example of a trader watching their position move into profit. Instead of following their predetermined exit strategy, they start thinking about all the things they could buy with the profits. They imagine telling their friends about their success. This emotional attachment clouds their judgment and prevents them from executing their plan objectively. As Mark Douglas explains so clearly, the market itself does not generate happy or painful information. The market simply exists in a state of neutrality. It is the individual trader's perception and emotional response that creates all the drama and suffering. This represents the point where most traders experience failure. They never prepare themselves psychologically for what trading actually demands. They fail to realize that their own emotions, including fear, greed, hope, and regret, shape their trading decisions far more powerfully than any strategy ever could. The psychological preparation that successful traders undergo is similar to what professional athletes experience. Just as a tennis player practices managing their emotions during pressure points, traders must develop the mental discipline to execute their strategy regardless of whether they are winning or losing. Fear and greed operate as the two most powerful forces that dictate market behavior patterns. When traders witness a trade moving against their position, fear immediately takes control of their decision-making process. Instead of following their predetermined plan, they panic and exit their position far too early, often right before the market reverses in their favor. Consider this real-world example. A trader enters a swing trade, expecting the stock to reach a target of $50 over the next week. The stock drops 2% on the first day, and fear immediately takes over. The trader starts imagining worst-case scenarios. What if the company announces bad news? What if the market crashes? These fearful thoughts have nothing to do with the original analysis, yet they drive the trader to exit the position at a loss, only to watch the stock reach their target 3 days later. On the opposite end of the emotional spectrum, when a trade moves into profitable territory, greed begins to dominate their thinking. They hold on to winning positions far too long, hoping to extract even more profit from the market. They watch helplessly as their gains disappear when the market inevitably reverses direction. Here is a classic greed scenario. A day trader enters a position expecting a quick 2% gain. The stock moves up 3% within the first hour, already exceeding expectations. Instead of taking profits according to plan, greed whispers that this could be the big winner. The trader holds on, watching the stock climb to 5% gains, then 6%. They start calculating how much money they could make if this continues. By the end of the day, the stock has reversed completely, turning their profitable trade into a loss. A truly disciplined trader never allows emotions to dictate their trading actions. They understand completely that markets move according to probabilities rather than certainties. Instead of reacting emotionally to every price fluctuation, they stick rigidly to their predetermined plan, accepting both winning and losing trades as natural parts of the overall process. Professional traders develop what psychologists call emotional regulation. They practice techniques like deep breathing, meditation, or simply stepping away from the screen when they feel emotions rising. They treat each trade like a surgeon treats each operation, with complete focus on the process rather than getting excited or worried about individual outcomes. Hope and regret create a particularly destructive cycle that traps countless traders in patterns of failure. Consider how many times you have entered a trade, watched it move against your position, and instead of cutting your losses according to plan, you hoped desperately that the market would eventually turn around in your favor. Let me share a detailed example of how hope destroys trading accounts. James enters a trade buying shares at $100 with a stop loss at $95, risking 5% of his position. The stock drops to $96, approaching his stop loss. Instead of following his plan, hope takes over. He tells himself, the stock is just testing support. He moves his stop loss to $90, then to $85 as the stock continues falling. His 5% risk turns into a 20% loss because hope prevented him from accepting a small, manageable loss. This represents one of the most dangerous psychological traps that exists in trading. Hope keeps traders trapped in losing positions far longer than any rational analysis would justify. By the time they finally realize their mistake and exit the trade, the loss has grown to devastating proportions that damage both their account and their confidence. Following these painful experiences comes the crushing weight of regret. Traders experience regret for not following their original plan, regret for not taking profits when they were available, or regret for missing out on obvious opportunities. This regret creates a foundation for emotional decision-making that leads to even more costly mistakes, creating a vicious cycle that becomes increasingly difficult to break. The regret cycle works like this. After the devastating loss caused by hope, James feels intense regret. He regrets not sticking to his original stop-loss. He regrets not trusting his analysis. This regret makes him doubt his next trade setup. When a perfect opportunity appears, he hesitates because he is afraid of making another mistake. He watches the trade work out exactly as predicted, which creates even more regret for missing the opportunity. This emotional roller coaster continues indefinitely. The solution requires building genuine psychological strength and emotional resilience. If you truly want to succeed in trading, you must train your mind with the same intensity and dedication that you apply to developing your technical skills. This training involves specific exercises and practices. Successful traders often use visualization techniques, imagining themselves executing their plan perfectly, regardless of market outcomes. They practice mindfulness meditation to develop awareness of their emotional states. They study their past trades not just for technical lessons, but to understand their emotional patterns and triggers. Mark Douglas emphasizes repeatedly that successful traders never become emotionally attached to any individual trade outcome. They understand completely that losses represent an inevitable part of the trading process, and they focus entirely on executing their statistical edge rather than reacting emotionally to every minor price movement. Think of trading like running a casino. Casino operators know they will lose money on some individual bets, but they focus on the statistical edge that ensures profitability over thousands of bets. Professional traders adopt this same mindset, understanding that their edge plays out over many trades, not on any single position. The question becomes how to train yourself to think and act like a truly disciplined trader. The answer lies in developing deep self-awareness about your emotional patterns. You must learn to recognize exactly when emotions begin driving your decisions, and you must consciously step back from the emotional intensity before making any trading choices. This self-awareness develops through careful observation and practice. Start by noticing physical sensations that accompany emotional trading decisions. Does your heart rate increase when a trade moves against you? Do you feel tension in your shoulders when considering taking profits? Do you hold your breath when placing an order? These physical cues can serve as early warning signals that emotions are starting to influence your decision-making. Some traders use specific techniques to interrupt emotional decision-making. They might count to 10 before making any trade modification. They might write down their reasoning before taking any action. They might call a trading partner to discuss their thinking. The key is creating space between the emotional impulse and the trading action. Keeping a detailed trading journal becomes essential for this development process. You need to analyze your emotional responses to different market situations and build the habit of detaching yourself completely from the outcome of any single trade. At the end of the day, the market is never your enemy. Your lack of psychological preparedness represents the true obstacle to success. A comprehensive trading journal goes beyond recording entry and exit prices. Document your emotional state before, during, and after each trade. Note what you were thinking when you entered the position. Record any deviations from your plan and the emotions that drove those decisions. Track patterns in your behavior across different market conditions. This detailed self-analysis reveals the specific psychological patterns that either support or sabotage your trading success. One of the most significant reasons traders fail involves their complete inability to accept risk as a fundamental part of trading. They enter the market hoping to win every trade, but they never fully embrace the reality that losses represent an inevitable part of any successful trading career. When they do face losing trades, they panic, hesitate, or make completely irrational decisions. This risk aversion manifests in numerous destructive ways. Some traders research trades endlessly, never pulling the trigger because they cannot find absolute certainty. Others take tiny positions that could never generate meaningful profits because they are terrified of losing money. Still others use extremely tight stop losses that get triggered by normal market noise, turning winning strategies into losing ones. As Mark Douglas states with perfect clarity, you do not need to know what will happen next in order to make money from trading. You simply need to execute your trades without fear clouding your judgment. Consider the analogy of professional poker players. They do not need to know what cards will come next to be profitable. They understand pot odds, position, and opponent behavior patterns. They make decisions based on incomplete information and statistical edges. Most importantly, they accept that losing individual hands is part of being profitable over time. This represents exactly where most traders go wrong in their approach. They believe they need absolute certainty to succeed in the markets. They desperately want a system that tells them exactly when to enter and exit every trade with zero risk of failure. The harsh truth is that certainty does not exist anywhere in the financial markets. Even the most sophisticated trading algorithms and institutional systems experience losing trades regularly. The difference is that professional trading operations focus on risk management and statistical edges rather than trying to predict specific outcomes. They understand that uncertainty is not a problem to be solved, but rather the fundamental nature of markets that creates opportunity. Fear of losing money operates as a silent killer of trading success. Imagine a trader who has just experienced several back-to-back losing trades. The next time they identify a high-probability setup, they hesitate before entering. What if this trade also fails? What if they lose even more money? This fear grips them so tightly that they either avoid taking the trade completely or they enter the position but exit far too early before the trade has any real chance to work out properly. Let me describe a specific example of how fear destroys trading success. Maria has a proven strategy that wins 60% of the time with an average win size larger than her average loss. After hitting a string of 3 losing trades, fear takes over her decision-making. When her next setup appears, she hesitates and enters late, getting a worse price. When the trade moves slightly against her, she exits immediately rather than giving it room to work. She has turned a potentially profitable trade into a loss purely because fear prevented her from executing her proven process. The fear often becomes self-fulfilling. Traders who are afraid of losses start making decisions that actually increase their probability of losing. They exit winning trades too early, cutting their profits short. They hold losing trades too long, hoping to avoid realizing the loss. They skip high-probability setups because they are afraid of being wrong. These fear-based decisions systematically destroy any statistical edge their strategy might have. On the opposite end of the spectrum, some traders react to losses by doing exactly the opposite. They refuse to accept that losses represent a normal part of trading, so they begin increasing their position sizes dramatically, hoping to recover their losses quickly through more aggressive risk-taking. This reckless behavior almost always leads to even larger losses and potentially catastrophic account damage. This revenge trading mentality often leads to what traders call going on tilt, borrowed from poker terminology. A trader who is on tilt abandons all risk management and rational analysis. They start taking trades based purely on emotion, often doubling down on losing positions or taking excessive risks in an attempt to quickly recover losses. This behavior pattern has destroyed more trading accounts than any market crash or unexpected news event. In both situations, the core problem remains identical. These traders are simply not comfortable with risk as a fundamental aspect of trading success. The comfort with risk that professional traders develop comes from understanding position sizing and money management. They never risk more than they can afford to lose on any single trade, which removes the emotional intensity from individual outcomes. They understand that losing trades are simply the cost of doing business, like inventory shrinkage for a retail store. Professional traders understand completely that trading represents a probability game rather than a certainty game. Not every individual trade will produce a profit, but over a large series of trades, a well-executed strategy will generate consistent profitability. Instead of focusing obsessively on the outcome of any single trade, they focus entirely on the process of executing their statistical edge consistently, regardless of short-term results. This probabilistic thinking requires a fundamental shift in perspective. Instead of asking whether a specific trade will win or lose, professional traders ask whether they are executing their process correctly. They evaluate their success based on whether they followed their rules, not on whether individual trades were profitable. Consider how insurance companies operate. They know that some policyholders will file claims, but they price their premiums based on statistical analysis of large groups. They do not worry about individual claims because their profitability depends on the overall statistical edge across thousands of policies. Professional traders adopt this same mindset. This represents exactly what Mark Douglas emphasizes throughout his work. The key to long-term success involves trading without fear, controlling your decisions. Fear only exists when you believe the market should behave in a certain predictable way. When you truly accept uncertainty as the natural state of markets, the fear simply disappears. The acceptance of uncertainty is liberating for traders. Once you stop trying to predict specific outcomes and focus on executing your process, trading becomes much less stressful. You stop taking market movements personally. You stop feeling like the market is out to get you. You start seeing market volatility as the source of opportunity rather than something to be feared. If you truly accept risk as fundamental to trading, then you automatically plan for it in advance. This means implementing proper position sizing by never risking more money than you can comfortably afford to lose on any single trade. It means using stop losses so that every trade has a predefined exit point that protects your capital. It means maintaining emotional control so that whether you win or lose your next trade, you execute it with exactly the same level of discipline. Proper position sizing is perhaps the most important risk management tool available to traders. A simple rule that many professionals follow is never risking more than 1 to 2% of their total account on any single trade. This means that even a string of 10 losing trades in a row would only result in a 10 to 20% drawdown, which is completely recoverable. Risk management serves dual purposes in successful trading. It protects your trading capital from catastrophic losses, but more importantly, it protects your psychological state from emotional damage. When you know with complete certainty that no single trade can define your overall success, you can trade with genuine confidence and clarity. The psychological protection that proper risk management provides cannot be overstated. When you know that your maximum loss on any trade is predetermined and acceptable, you can focus entirely on execution rather than worrying about outcomes. This mental clarity leads to better decision-making and more consistent results. The bottom line is simple and non-negotiable. If you cannot accept risk as fundamental to trading, you cannot trade successfully, period. The moment you shift your mindset from trying to avoid all losses to executing your strategy without fear, everything changes dramatically. Trading success is never about being right all the time. Success comes from managing risk effectively, embracing uncertainty completely, and staying in the game long enough for your statistical edge to play out over time. One of the most devastating mistakes traders make involves allowing their emotions to control their decision-making process completely. They begin each trading session with a clear plan, but the moment market conditions do not unfold according to their expectations, emotions take over and they react impulsively rather than following their predetermined strategy. As Mark Douglas explains, this emotional reactivity represents exactly what separates professional traders from amateurs. The best traders never hesitate when action is required, and they never let fear or greed influence their execution. The market operates without any concern for human emotions. It rewards discipline and consistency while punishing emotional decision-making. Let me break down the two most dangerous emotional traps that lead directly to trading failure. Revenge trading represents the trap of complete desperation. Picture this scenario clearly. You have just taken a trade that went horribly wrong, producing a significant loss. Instead of feeling frustrated, you immediately jump into another trade without conducting proper analysis, driven purely by the desire to make back your lost money as quickly as possible. This revenge trading mentality represents one of the fastest ways to completely destroy a trading account. When traders allow their frustration to drive their decisions, they stop executing a coherent strategy and start making random, impulsive trades based purely on emotional reactions. Instead of trading the market, they attempt to fight the market, which is a battle they cannot win. The harsh truth that every trader must accept is that the market does not care about your losses. It will never give you your money back simply because you feel upset or frustrated. Every single trade must be taken based on logical analysis rather than emotional reactions. Overconfidence creates the illusion of invincibility and represents the opposite problem. Imagine you have just experienced a series of winning trades and suddenly feel completely unstoppable. You increase your position sizes dramatically, you start taking trades outside of your proven strategy, and you ignore risk management principles because you believe you have discovered some secret to market success. Then reality hits with devastating force. The market does not care about your winning streak or your confidence level. One poorly managed trade can eliminate all of your previous profits and more. This is exactly why Mark Douglas emphasizes that professional traders never become attached to wins or losses. They follow their proven process, trade after trade, without hesitation and without arrogance. Fear and greed operate as invisible forces that destroy trading success. Fear makes you hesitate when you should act decisively, cut winning trades too soon, or avoid taking high-probability setups altogether. Greed makes you overtrade your account, chase poor setups, and take excessive risks that can destroy months of careful progress. If you allow these emotions to take control of your trading, even the most sophisticated strategy will fail to produce consistent results. Building emotional discipline requires a systematic approach. First, you must create a detailed trading plan and follow it without deviation. If you do not have clear rules established in advance, emotions will control every decision you make. Second, you must accept every trade as simply one event in a long series of similar events. Stop treating individual trades as life-or-death situations that define your worth as a trader. Third, implement proper risk management so that your financial exposure remains under control at all times. When your risk is properly managed, you will not feel the overwhelming need to react emotionally to normal market fluctuations. Fourth, take breaks after experiencing big wins or significant losses. If you feel emotionally charged in any way, step away from your trading screens before making another trade. Trading represents a game of discipline above all else. If you allow emotions to control your actions, you are not trading in any meaningful sense. You are simply gambling with your money. The best traders never hesitate when action is required. They never second-guess their predetermined plans, and they never seek revenge against the market for previous losses. They act when they need to act with no emotional interference, no impulsiveness, and nothing but pure execution of their proven process. Many traders make the critical mistake of believing that success lies in finding the perfect indicator or mastering some secret chart pattern. They think that if they can just master technical analysis completely, they will be able to predict market movements with near-perfect accuracy. Mark Douglas makes it absolutely clear that charts do not predict the future in any reliable way. Charts help you understand what is happening in the present moment so you can make informed decisions accordingly. This represents where most traders go wrong in their approach to market analysis. They treat technical analysis as some kind of crystal ball rather than understanding it as a tool for interpreting current market behavior patterns. New traders frequently fall into the trap of believing that finding the right setup guarantees a profitable trade outcome. They become obsessed with moving averages, relative strength indicators, Fibonacci retracements, and candlestick patterns, thinking these tools will tell them exactly what the market will do next with mathematical precision. The market is not a machine that follows fixed, predictable rules. It represents a living, breathing system driven by human emotions, supply and demand dynamics, and constantly changing conditions that no indicator can fully capture. A perfect technical setup does not guarantee that the trade will work out as expected. There is no certainty in trading, only probabilities that may or may not play out. A trader who focuses exclusively on technical patterns while ignoring the psychology behind price movements is trading completely blind to the most important forces moving the market. Support and resistance levels do not hold because of lines drawn on a chart. They hold because traders collectively believe in them and act accordingly. Breakouts do not fail because of some fake breakout pattern. They fail because market sentiment shifts unexpectedly. Indicators do not work because they are mathematically perfect. They work because traders react to them in somewhat predictable ways based on human psychology. Successful traders do not simply follow indicators blindly. They understand exactly why those indicators work when they do work. They look beyond the chart to analyze the emotions and behavior patterns driving price action in real time. Imagine two traders analyzing the same breakout setup. The first trader sees a clean technical pattern and enters immediately without further analysis. The second trader asks deeper questions. Is this breakout happening on strong volume that indicates genuine buying interest? Are traders positioned heavily in one direction, making a reversal more likely? Is there news or an upcoming event that could impact market sentiment dramatically? The first trader follows the pattern blindly without understanding context. The second trader understands the context completely and makes a decision based on both technical analysis and market psychology. Which trader do you think has a genuine edge in the market? Mark Douglas emphasizes that a trading strategy represents just a tool for market analysis. Your ability to execute that strategy correctly represents the actual skill that determines success or failure. Do you take trades mechanically without understanding why they work? Do you blindly trust indicators without adapting to changing market conditions? Do you expect the market to behave a certain way? Or do you react to what the market is actually doing right now? The best traders never attempt to predict future price movements. They react to current market conditions with flexibility and understanding. They use technical analysis as a guide for decision-making, but they combine it with a deep understanding of how traders think, feel, and behave under different market conditions. One of the most significant reasons traders fail involves not having a solid, well-defined trading plan. They enter the market with excitement and optimism, but no real strategy for success. They rely on gut feelings, random setups, or emotional impulses, which represents nothing more than gambling with their money. As Mark Douglas states clearly, without a proper plan, a trader is simply gambling rather than trading professionally. A professional trader never takes any trade without having a complete plan in place first. Every move is calculated in advance, every risk is managed properly, and every decision is based on a well-defined strategy that has been tested thoroughly. Trading without a plan creates emotional chaos that guarantees failure. Imagine a trader who enters a position simply because a stock appears to be moving strongly upward. They have no clear entry price, no predetermined stop-loss level, and no idea where they plan to take profits. What happens when the trade moves against them? They panic immediately. Should they exit the position or hold on hoping for a reversal? Fear clouds their judgment completely. What happens if the trade moves in their favor? Greed takes over their thinking. Should they take profits immediately or wait for even more gains? Overconfidence leads to poor decisions that erase their gains. Without a plan, every single trade becomes an emotional roller coaster ride. The trader is not following any coherent strategy. They are simply reacting to emotions, and in the long run, that represents a guaranteed path to failure. A comprehensive trading plan includes several essential elements. Entry rules define exactly what conditions must be met before you enter any trade. Is the entry based on price action, technical indicators, or fundamental news? Exit strategy determines when you will take profits. Will you exit at a fixed target or trail your stop loss to capture larger moves? Stop-loss placement defines the maximum risk you are willing to accept on each individual trade. Position sizing determines how much of your total capital you will risk per trade. Market condition analysis helps you understand whether your strategy works in all market environments or only in trending or ranging conditions. Without these clearly defined rules, trading becomes random gambling instead of a structured, professional process. Mark Douglas emphasizes that the best traders are consistent in their approach above all else. They do not win because they have access to secret indicators or insider information. They win because they execute their plan exactly the same way every single time without deviation. They do not chase trades that do not meet their criteria. They wait patiently for their predetermined setup to appear. They do not hesitate or second-guess themselves when their setup appears. They follow their rules without emotional interference. They do not risk everything on one trade, hoping for a home run. They manage their capital wisely according to their plan. This consistency represents exactly what separates professionals from amateurs in every market condition. If a trading plan is so critically important, why do most traders ignore this fundamental requirement? The answer is simple. Creating and following a plan requires genuine discipline and personal accountability. A plan forces you to take complete responsibility for your trading results. You cannot blame the market, the news, or bad luck when you lose money. It means you either did not follow your plan properly or your strategy needs adjustment based on market feedback. Many traders avoid this level of accountability completely. They prefer the illusion of control that comes from making decisions based on feelings rather than following logical rules consistently. One of the most common reasons traders fail involves their complete inability to learn from their mistakes effectively. Every trader makes mistakes regularly. This is absolutely inevitable. Even the most successful traders in the world experience losing trades and make poor decisions occasionally. What separates successful traders from those who fail is exactly how they handle those mistakes when they occur. As Mark Douglas explains, trading mistakes are inevitable, but failing to learn from them represents a choice that leads to repeated failure. Most traders repeat the exact same errors over and over again, hoping somehow for different results. They never analyze their past trades systematically. They never adjust their strategy based on what the market teaches them. They never take personal responsibility for their actions. This keeps them trapped in a never-ending cycle of failure. Here is how a typical losing trader's cycle operates. First, they take an impulsive trade. Maybe they enter too early, ignore their stop-loss completely, or let emotions control their decision-making process. Second, they lose money when the market moves against their position. Instead of accepting this as a valuable learning experience, they feel frustrated and angry. Third, they blame external factors for their loss. Instead of analyzing what went wrong with their approach, they blame market manipulation, unexpected news, or bad luck. Fourth, they make exactly the same mistake again. Since they never reviewed their mistake properly, they repeat it in the very next trade opportunity. This destructive cycle continues repeating until their entire trading account is completely wiped out. Mark Douglas and other professional traders emphasize the critical importance of keeping a detailed trading journal. This journal helps you identify patterns in your behavior and improve your performance over time. A proper trading journal should include the specific reason for entering each trade. Was it based on your proven strategy, or was it an emotional decision? Document your emotions during the trade. Did fear or greed influence your choices in any way? Analyze what went right or wrong. Did you follow your plan completely, or did you deviate from it? Record what you learned from each experience. What would you do differently next time? By consistently reviewing your past trades, you will start noticing clear patterns in your mistakes. Once you identify those patterns clearly, you can fix them and improve your performance. Most traders struggle to accept personal responsibility for their mistakes. They prefer to blame external factors they cannot control. The market was manipulated by big players. The news was completely unexpected. The broker was working against them. The truth is that the market does not care about your feelings or circumstances. Successful traders take complete responsibility for every decision they make. They do not make excuses for poor performance. They analyze their mistakes, adjust their approach, and move forward with improved understanding. When a trade goes wrong, they ask, "What could I have done better?" If they hesitated to enter a good setup, they ask, "Why did I doubt myself?" If they ignored their stop-loss, they ask, "What emotions caused me to make that choice?" This mindset shift represents exactly what separates winners from losers in trading. If you do not own your mistakes completely, you cannot fix them effectively. The harsh reality is that most traders fail because they let emotions take control, make impulsive decisions, or refuse to accept risk as fundamental to success. Failure becomes almost guaranteed when you operate this way. But here is the encouraging news. You can break this cycle of failure completely. You can develop genuine discipline, learn effectively from your mistakes, and treat trading like a skill that requires constant improvement and development. The market does not reward the smartest traders or those with the most sophisticated analysis. The market rewards the most disciplined traders who can execute their proven process consistently over time. This discipline extends beyond just following trading rules. It includes the discipline to continuously educate yourself, to adapt your strategies as markets evolve, and to maintain the emotional equilibrium necessary for long-term success. The traders who survive and thrive are those who treat trading as a professional skill that requires constant development and refinement, much like a musician who practices daily to maintain and improve their abilities. The journey to becoming a consistently profitable trader is not about finding the perfect strategy or indicator. It is about developing the psychological skills and emotional discipline necessary to execute any reasonable strategy consistently over time. The market will always present opportunities for those who are prepared psychologically to recognize and act upon them without being derailed by fear, greed, hope, or regret.